But when we do think about the last year, the thing that really surprised me, and I think maybe we all knew it was possible in our brain, but maybe not in our heart, is this idea of 500 basis points of increase in interest rates and the impact on all of our strategic asset allocations. We think very long term, the allocators up here, about how to allocate to those different asset classes. And maybe about a year ago, a year is a good time to look back. The Fed has started raising, and I was talking to a market strategist, and she said to me, fixed income is back. And I was like, fixed income's not back. Fixed income cannot be back. I started my career in the early 1990s in fixed income. And, fixed income's near and dear to my heart, but I run a pension fund where our assumed rate of return is 7%. And if fixed income is at 2% or 2.5% for a decade or more or for a very long time, we can't own that. So public pension funds, you always think of them as being 60-40, 60% stocks, 40% public fixed income. We actually haven't been able to own that for quite a long time. So when someone comes to you and says fixed income is back, it took me a long time for that to really register. But now, 10-year at 4.6, you start putting spreads on that. It started to become very interesting to someone who is charged with delivering 7% to the 2 million members of our fund. And I think you see it here today. The two prior panels, I think I heard the words private credit, private credit, private credit many, many times, and that's not an accident. I mean, private credit is certainly on the upswing at this point in time because of those attractive returns, and private equity, which those are managed oftentimes by the same firms, that's a little bit kind of angling down over time as well. So, and just thinking about those issues. Credit is back. And Ed, I know you guys own a lot of credit at CPP.
Yes, we do, and it's part of a balanced portfolio construction that we've adopted. I think it's a really interesting point that you're making, though, in terms of being sure about what the objectives of the fund are and then what the impact of that is on portfolio design. I know there's a lot of funds that, sounds like your fund is one of them, that are return targeters more than risk targeters. We're kind of in the opposite boat. We risk target first, so we think about what capacity the fund has to bear risk, and then we try to maximize returns at that level of risk. So for us, the real impetus is how do we construct a portfolio that delivers the maximum level of return without endangering the assets of the fund. And that's really a combination of two things for us. That's building a really highly diversified portfolio to try to take advantage of the benefits of diversification, then trying to look to those areas of the market where we think we have an advantage and we can earn alpha. And Jase, as you alluded to, we own Antares Capital, which is a mid-market loan generator in the US. So we think there's a ton of alpha there in terms of origination, in terms of being able to actively select credits, and that's one of the reasons we're in it. But fundamentally, the system that we have is probably a little bit different than the system that you have. And if you're return targeting as opposed to risk targeting, I think you're absolutely right. I think you have to really take a look at the market now and say what's available in the market, and can I construct, it's probably the opposite of us, can I construct a lower risk portfolio that still delivers the same level of return? And the big thing that's happened in the market, and this is something we were worried about 2 years ago or 3 years ago when you took a look at pricing in terms of the fixed income market, the real rate in perpetuity was priced at minus 150 basis points, which is kind of extraordinary. You think about what that means for asset prices, and you saw it, like bonds were trading at all-time highs in terms of price and equities in terms of multiples. That's because real rates are really low, and that stimulates growth as well. It's kind of the perfect world for equities. And fast forward now, that real rate's gone from minus 150 to almost close to 200 basis points. That's a huge move. And in terms of portfolio construction, I think that does have implications for where you want to be.